Got to talk about software looking a little sick, but this is nothing new. We've been tracking the dichotomy between semiconductors and software for a while. Neither one had a particularly good day, but software came out way worse. And let's just take a look. This is our heat map of software today. Only Cisco in the green. This is not comprehensive, but you sort by performance. You can see, look, a lot of these names down 9-10%. So this is kind of a big deal here. And then if we take a look at the year to date, it gets a lot worse. We're seeing on the bottom row, Teladoc down 27, all the way to HubSpot down almost 40%. Only Cisco and Zoom in the green here. And then you take a look at semiconductors year to date. That is a vastly different story. Notably, NVIDIA and Broadcom are down, but the others, the smaller ones, are making up for it. And you can see that SanDisk almost up 200%, Western Digital up 70. And let's check out a comparison between two ETFs. We got IGV versus SOX. And guess which one is positive? That would be the chip stock, SOX, that's up 15% versus IGV down 20%. And if we show a 1 year, we can see where things kind of diverged. And here are those scary April lows we had post-Liberation Day last year. But it was really in October when chip stocks kind of, for the most part, went up and software was just flatlining. And then this year, well, actually starting in December and then accelerating into January, we just saw software kind of fall off. So a lot of this is being ascribed to AI and that whole story, but it's kind of telling when Microsoft cannot catch a bid, and Microsoft is down from $4 trillion to a $3 trillion company now.
All right, so software looking a little sick. What's not sick?
For that, we got to look at value, and let's try to value that. And I'll go back to my comparison screen here because I got something interesting. I'm going to show you the Russell 1000, which is large cap stocks, growth versus value. And let me just bring this down to our year to date first. There we go. And so value is up 5% this year. Growth is down 3%. What's the difference? Growth is your tech names, the companies that are just growing at a large rate. Value tends to be those stocks. Doesn't mean that they're necessarily depressed always in price, but a lot of times they are. And those are the stories where you're looking to unlock value. So GameStop was a classic example. 2019, 2020, Michael Burry went long, of course, a roaring kitty, all of that good stuff. But suffice to say that, so we're seeing a big divergence this year. And again, if I show a 1 year chart, you can see, well, they're almost about the same from 1 year ago. But that's because growth got absolutely killed here in those post-Liberation Day lows, whereas value held up a little bit more. And I'm going to show you another way of looking at this. If we go to the large cap sectors, and we'll keep this on year to date, if I look at what is winning this year, energy, materials, staples, industrials, utilities, all of these except materials are potential value sectors. And why is materials in there? That's because it's up because of gold and silver. So suffice to say that the value stocks have really been leading this year.
So let's switch gears here, talk about Bitcoin.
Yes.
Because did I see Bitcoin drop below the Jared Blickery line in the sand? Is that what I saw?
It did. Yeah. Let's check out the latest price. I said if it goes below 70,000, probably crypto winter. But if it hits if it hits 70 and it bounces back and stays above 80, well, then we could have a different scenario. That could just be a washout of the week long. So here's Bitcoin down 14%. And here is that big sell-off that we saw today. Let me put the 3-year back on so we can see why I like 75. It was a 2024 highs, a 2025 lows, and there we go. Now we have dipped below it, and what I liked, I'm going to show you the 5-day price action here. What I liked yesterday is we hit a low, and you can't even see this because we need candlesticks, but we bounced up pretty sharply off of that. But what I don't like is we should have continued that. Instead, we just kind of leaked lower, and then we had another waterfall to the downside. So I'm not counting out the bull case here, but it's looking not the best. And if 75,000 ends up being a ceiling instead of a floor, and then we head below 70, well, that's a crypto winter scenario.
All right, thank you, buddy. Appreciate it.
What do you make of this combination? What does it do for you as a shareholder, fundamentally for the company?
We happen to be a shareholder in both SpaceX and xAI. So, I do think it's the right move long term. It does cost a lot of money to build a data center in space, but because of the nonstop 24 hours energy from solar, and you could cool these data centers much more efficiently in space. So about 3 to 4 year period, you will get back that cost, and at that point going forward, you're operating at a much more efficient cost basis than you would on land.
I mean, so effectively here is SpaceX in the short term a piggy bank for xAI to be spending all of that money?
Look, I think Elon was a little bit late to the game on the AI front. This guy's got a lot going on, obviously, as we all know. But if you look at like where Anthropic and where ChatGPT is, their Chat's obviously the biggest from a revenue standpoint, pushing 20 billion last year, and Anthropic about half of that, around 10 billion. xAI only probably did about 500 million in revenue, and was burning about $1 billion a month. So I think Musk was looking at that burn, wanted to reduce that burn, and was looking a little bit longer term and said, look, I got a lot of catching up to do. If I could start building these data centers in space and be one of the first ones to do this, a few years from now when the coin flips, you'll have a lot of data centers that'll be extremely efficient. And I think in 26 into 27, you'll see a very big revenue ramp on xAI. So I think it's the right move by merging the companies. I think it makes a lot of sense.
The whole data centers in space thing, I mean, the timelines are wildly divergent here. And, folks who I've talked to who are experienced in the space area say it really is a very, very challenging engineering feat to make this work. We know Musk, he has a loose relationship with timelines. So when does this need to happen for this to really be viable and make a lot of financial sense?
Sooner than later.
Yeah.
The race for AI.
But can it happen sooner than later, I guess is the question.
If anyone can pull it off, Elon can. But, I do think that, again, I think the integration will happen quicker than people think. People are now talking about the IPO that he put a very bold statement out on being public by June of this year. And that was before he announced that he was going to be merging xAI into the company. So I'm not sure if that June date is still viable. That may have to, move out a little bit because that's a monumental task in itself, getting public by June with these two companies. But as far as putting a data center in space, with that Falcon rocket, if anyone can pull it off, I think Elon will be the first one to do it. And if the first one works, you can bet your bottom dollar he's going to be putting a lot more up there very quickly. So.
Let's talk a little bit more about the IPO, right? Because there's sort of we got our space race and then we got our IPO race, because it seems like people are waiting for SpaceX, of course, to go public. OpenAI would be the other big one that people are waiting for this year. Polymarket puts the odds of SpaceX going public first at pretty high, 72%, the last time we checked here. Does it matter who goes first? Do you think SpaceX is going to go first, and does it matter who goes first?
I definitely think SpaceX is going to go first before OpenAI, and I think Anthropic will probably go first before OpenAI. I just don't think that OpenAI has everything together in order to put a filing together soon. They got a lot going on. They had a lot of management defections that a lot of people left there and actually went over to Anthropic. We have Anthropic in our portfolio. That's our biggest position. We do believe that Anthropic over the next couple of years will actually overtake OpenAI as far as from a revenue standpoint. OpenAI right now is very large with a consumer base, but which is as you know can jump from one platform to another very quickly. They really don't have any allegiance to anybody. Anthropic chose to go a different route and really chose to go towards the enterprise customer, and they don't jump that quickly. When they integrate systems into their embed systems into their infrastructure, they tend not to jump. So I do think that Anthropic right now is already doing more revenue in the enterprise space than OpenAI. So I do think that the future there's not going to be one winner. This is a gigantic space. Artificial intelligence, you need to look at almost like a new platform, almost like the iPhone. There's going to be many businesses that we don't even know about yet, but we will know quickly that are going to thrive over the evolution of OpenAI, the same way DoorDash and let's say Uber they'd offer the smartphone. They couldn't have done it without the smartphone. And you're going to see a bunch of new businesses that couldn't be here because they didn't have open AI, and they're going to evolve very quickly. So it's exciting times. It's a new, this is a new platform that's going to generate a lot of business across many new businesses.
And Joe, when we talk about these companies going public, I mean, the time, I mean, you know this very well being in this business, it's unprecedented in terms of the size of these private companies and the number of different shareholders in these private companies, right? So I'm curious, are people itching to get out, right? Once these companies go public, they're probably going to see a pop, and then once the lockup ends, are we going to see pretty significant selling because people have ridden these things up for quite a while now?
I don't think so. I'm a believer that you're going to see, and I think you're already starting to see, some of the smart institutional money starting to rotate out of what's worked over the last 10 years, right? The Mag 7. Those stocks are under pressure, and I do think that the money's got to come from somewhere. When you talk about the size of these offerings, these are unprecedented raises and valuations that have never been seen before. But these companies on that growth rate, when you look at what's happening with AI, going from really no business in a couple of years to a company maybe able to do 10 to 20 billion in revenue, we've never seen that before. So the trajectory looks very strong going forward over the next several years. So I do think that what you're going to do is see shareholders, do quite the opposite. I think they're going to rotate out of the stocks that worked for the last decade and go into the new Mag 7, right? And it's probably going to be very AI centric. I do think that these are the companies that will outperform, not just at an IPO standpoint and have a pop, but year over year over the next few years. I think you're going to see significant revenue growth and cash flow. And these are the companies that you're going to want to be in. Unfortunately, the same way it was the last decade as far as concentration is concerned. The Mag 7 was driving the market, and a lot of people saw the market go high, and some people that were not in those stocks didn't have as much appreciation. I do think that you need to look at these stocks that are coming public, and the SpaceXs of the world, the Anthropics of the world, Databricks. I mean, these are companies that we have in our portfolio that we do believe are going to grow substantially 3 to 5 years, unlike any other public company that's trading today.
We shall see. Joe, thank you so much for joining us with your perspective. Appreciate it.
Thanks for having me, Julie.
A short list, not even a complete list of companies going public. Bob's Discount Furniture, AI marketing platform Liftoff Mobile, and organic food company Once Upon a Farm. It's not all AI companies, it's organic food companies too. Joining me is Ted Swimmer. He's the head of commercial banking at Citizens to talk about the outlook for deals, IPOs, and M&A included. And I know your purview is more broadly M&A, but IPOs sort of as a corner of that. What is it about this year? What has changed? Is it regulatory backdrop? What is it that is making this fertile ground for all this stuff?
Well, it's an exciting time, Julie, especially with us at Citizens. I would say when the new administration came in last year, it came in with a lot of expectations that we were going to see a very good M&A environment, we were going to see a very good IPO environment, and then right off the bat we hit Liberation Day, we had the worry of tariffs, and what markets really want to see is some understanding of what's going to happen next. When they buy a stock, when you make an M&A transaction, you want as little volatility as you possibly can have. So last year, as we got into this, we got hit right ahead with Liberation Day and the tariffs, and that really slowed the market down for a couple of months. And then right as we were getting going, we hit the government shutdown. So two things right out of the bat made it very difficult to have the confidence that if you put a company up for sale, if you went to the public markets, that you were going to get the right reception. I think for whether it's for good or for bad, we are now in a period of time where we understand volatility is what to be expected, and I think companies are more willing to take a risk of going public now and obviously the stock market has S&P at a record high yesterday. We've seen debt markets continue to tighten. We've seen basically the whole term loan market reprice over the last 30 days. We've seen investment grade bonds, high yield bonds at or close to the record tights on spreads. So things feel like the markets have started to look through the volatility, that there's more confidence that despite we may see some volatility on a day in out basis, that long term that this is a pro-business administration, and I think people are willing to take some risk and put their company up for sale or go public.
I mean, and that's reflected. You guys just did a survey and found that sentiment around M&A is at a 6-year high.
That's exactly right.
And is it mostly reflecting the sort of regulatory backdrop?
No, I think that a lot of things have happened. If you just take a step back, 2021 was a banner year for M&A. We had basically zero interest rates. We had private equity sitting on a lot of very profitable investments that they had made, and so there was a desire to realize the gains they had and then continue to put money to work. And then 22 came, we started to see rates go up. Valuations were not as lofty as they had been before. So there were a number of private equity, public companies who were sitting on investments that were just underwater. We've gone really 3 years from 22 to 24, even to 25, where valuations were kind of stuck in the mud a little bit. Starting with rates starting to come down, with more confidence we're in a more pro-business cycle. Mm-hmm. We're starting to see companies willing to take risk on reaching for a valuation. We're starting to see financial sponsors willing to understand that what they bought companies at 21 may not get to the lofty levels that they bought them at, but they're getting close enough that they need to get money back to their shareholders, so they're willing to transact. And then we're seeing investors in the equity markets being willing to reach again for good stories, where for 3 years we saw investors really concerned that if they reach for something that as soon as they did, it would trade down the secondary market. People are now looking for good assets to put to invest in, and we're seeing them come to the market now.
Where do you expect the activity to sort of be concentrated?
Well, I think we've been waiting for a while, especially at Citizens, after our purchase of JMP, which really focuses on the tech and biotech market. We think there's going to be a lot of good action there. So far this year, we've been on a number of IPOs that we've been covering, that we're going to cover from an equity perspective. So we're feeling good there. Obviously, AI right now is not AI. I meant digital infrastructure and data centers are seeing insatiable demand, mostly in the debt markets. But at some point, that's going to pivot to the equity markets too. And we have a real expertise at that at Citizens. So that's been a really good area for us. And we're starting to see some real pickup in the industrial space. So that's been nice to see. Healthcare still seems to be lagging a little bit. We're waiting for that. But in tech, biotech, data centers, and industrials, we're seeing a lot of activity right now.
So do you think we'll start to see some combinations of some of the data center owners, for example?
I don't know that we'll see a combination of the data center owners. Right now, I think they're more focused on how they're going to get power. We saw Google make an interesting acquisition today. I think they're looking for where they can get power and where they can continue to build and develop. So right now, most of our conversations going on with that client set is, how do we get you the properties in the right positions so you can continue to build and continue to hyperscale as you're doing.
We've talked about Palantir before. I know it's the valuation conundrum with this one, Gil. But the higher that its profit gets, the marginally better that valuation looks, right?
That's right. They were growing into their valuation even at 50% growth, and then they went to 60% growth, and now they're growing 70%. So they're going to grow into that valuation a lot faster than we thought. That doesn't mean that curmudgeonly old software analysts like us are going to be stuck in our ways and hard to recommend a stock trading at 60 times revenue. But the investors that have bought Palantir over the last couple of years sure are happy right now.
What do you think? How do you think about Palantir's business prospects? I mean, you listen to Alex Karp and you get a very optimistic view of what the growth is going to look like for the foreseeable future for this company. Where do you think sort of the biggest opportunities are still untapped for Palantir?
Well, opportunities abound. Right now, the main opportunity is in the U.S. commercial business. That's the business they just grew 137%. The reason is very simple. They're going to companies and they're telling the CEO, what's your biggest problem? We can solve it with AI. And CEOs are taking them up on it. These are very big contracts they're signing Palantir to, and Palantir is delivering, which makes selling to other CEOs very easy right now. So that's their biggest opportunity. It's not that they're not growing in US government 66% or growing internationally. They're growing internationally as well. But US commercial, you have so many companies that have spent 3 years trying to figure out how can AI solve my problems. And nobody's been able to do that for them except for Palantir. And it's what Palantir has been building over 20 years is paying off now. Their abilities to take companies' data and organize it well, they call that ontology. Their ability to deploy that with their own people, they call them forward deployed engineers. These are very unique capabilities they've developed over a long period of time. And in the era of AI, that's paying off. And they're able to do something that no other software company can do. That's why they're so successful, and doesn't look like it's going to slow down anytime soon.
Well, and you hit upon something that I really wanted to ask you about, which is sort of Palantir versus everybody else within software. As you well know, most software stocks have had a very rough go of it for really the past at least 6 months, if not longer. Palantir started to get rough towards the end of that period, but it really hasn't traded like its cohort. And do you think that that is justified? Do you think software broadly is going to continue to muddle along even as Palantir continues to grow?
We actually think that software companies are overly maligned right now. They do provide very valuable services to their customers. They're still very good businesses, growing fast, with good margins that can scale well and are hard to switch out of. The software business is still good. We understand concerns about AI. We're in a period of uncertainty. But the answer that includes Palantir is good software companies will execute well as this technology disruption happens and will win. Bad software companies will falter. This is like 30 years ago when we started buying things online. Best Buy and Circuit City were in the same boat. And here we are today. Best Buy is a big, thriving business, and Circuit City's been bankrupt for 25 years. Good software companies will succeed in the era of AI, and there's no better software company than Palantir.
So I guess to oversimplify it, what separates a good software company from a bad software company? Is it just what you talked about earlier, that Palantir comes to a company and says, we can solve your problem, and they actually solve it? And maybe not everyone is doing that to the same degree right now.
That's right. So a good software company is the company that's market leader, that helps their customers solve problems, and importantly, helps their customers adopt a new solution. So I'll give you a couple of examples that are top of our list right now. Snowflake and Datadog. Snowflake's the leader in data warehouse, data lake type services. You can't do AI unless your data is all in one place. That's Snowflake. Datadog, the leader in observability of applications and infrastructure. You can't deploy AI solutions without keeping an eye on them. It's the leader, and therefore it's also serving the AI natives like OpenAI and Anthropic, etc. Companies like that have evolved and are going to continue to evolve well with AI will win. And in fact, they'll win even more than before AI. And so not all software companies are created equal. There are software companies that will fall by the wayside, just like any technology wave. Software life cycles are very short. You either succeed wildly or you get bought by private equity. There's really very few companies that have just been around for a long time. And so the good companies will do well, but there will be victims just like any other technology disruption.
Gil, while I have you, I do want to ask you about a couple of companies that report still this week. That's Amazon and Alphabet. Speaking of companies whose fortunes have diverged over the past year, you can look at these stock prices. Alphabet's up something like 70%, and Amazon hasn't done much of anything. Does that mean the bar is lower for Amazon, or does it still have a lot to prove here to investors?
Yeah, the bar is lower. No, good news for Amazon. The fourth quarter was good for the consumer. And they, in their retail business, they've been able to adapt well to tariffs and other challenges. So the retail business should do well. Margins should be strong because of how much automation and how much they've invested in their logistics and shipping to reduce costs there. And then on the AWS side, they're growing slower than Google Cloud and Azure, but they do have an opportunity to accelerate as they deploy more compute for Anthropic. So yes, there's been the laggard, but there's reason to think that if they do better, they'll get more credit for the fact that AWS is still the biggest hyperscaler. It's substantially bigger than Azure and even bigger lead over Google Cloud. So they still have the opportunity to grow in this market, and Anthropic should be helping them right now as they deploy more compute capacity for them.
And Gil, what does Alphabet need to say to keep the party going?
Yeah, so Alphabet's in good shape in the sense that Microsoft Azure's success probably means that Google Cloud is accelerated as well. Meta's success in selling ads probably means that Google advertising businesses around search, YouTube, etc. should accelerate. So they're in good shape. Expectations are very high. The multiple in the high 20s is about 10 points higher than it was just 3 or 4 months ago. So expectations are high for Google to win and dominate AI. That may be a little ambitious, but this quarter should be good because their two most important businesses should either stay at nice levels of growth or maybe even accelerate.
So we were just talking about Palantir, which seems to be almost its own entity within the AI universe. Mm-hmm. We've got Amazon and Alphabet coming out later this week, but it feels as though after the huge surge last year in spending plans, enthusiasm, that we've entered a different phase in the AI trade. How are you thinking about it now?
I think that's fair because if you look at the last 6 months or so, tech was going sideways. It didn't go anywhere, but there is a huge dispersion underneath the surface. You look at during the same period, the gap between software as a service and semis, it's 60% in performance, the difference between the two. So there is definitely greater differentiation within the AI ecosystem. But more broadly, I would say though, earnings are still quite strong. And because price hasn't gone anywhere, in terms of valuation attractiveness, it has become more attractive, but we just need to be more selective. So, thinking about the infrastructure layer that we favor, look at the likes of the hardware, compute, and chips as kind of the selective sub-themes that we like within AI versus software perhaps a bit less in favor because it's being disrupted a little bit more. But the bigger picture is that, like we in our global outlook talk about how we need to see new revenues being generated to support the significant capex spending commitment that these companies put out there. So it's not just about kind of taking a greater share of the same pie. The pie needs to grow. So over the medium term, we need to see companies, hyperscalers actually kind of thinking vertically, applying AI to other sectors, pharmaceuticals or financial services.
And when you're looking at the tech plays, the various subsectors, so you must be scrutinizing the growth trajectory, but also I'm curious how closely you're looking at balance sheets, if that has changed, or if you think that's something investors really need to focus on, given the enormous spending needs.
That's right. Actually, to your point about this is a slightly different phase in AI, it can be said about kind of the evolution of balance sheet as well, because up until now, a lot of these companies were able to fund their spending from their huge pile of cash, free cash flow. flow, and it has been somewhat really kind of easily kind of taken by markets. But because we're at this point where spending is still happening, and we're talking about similar level of capex for this year compared to last year, but revenue will take some time to come through, and the time gap between the spending and revenue creation means that we're going to need to see more leverage, which is why companies are going into the credit market to issue debt to fund their capex commitment. And this is a bit different because markets then start to scrutinize a little bit more and say, okay, what is your starting point? Can you afford to issue that? If you cannot afford to issue that, maybe you issue equity, which is what we saw in Oracle recently, right? So I think greater scrutiny around the health of the balance sheet is indeed a characteristic of this phase of AI. But the good news is that compared with the 2000, the starting point of these companies are so much healthier. They are issuing debt from position of net cash rather than position of net debt. So it will be a while yet before we look at the balance sheet in aggregate and say this is very worrisome.
Gotcha. The other thing I wanted to ask you about is we tend to speak a lot about the AI trade in the US, but you're a global strategist. And at the same time, we see this trend of more interest in international markets that really started to rise last year, but seems to be persisting. So how are you, how do you think investors should put those two things together? You know, think about the AI trade, but not exclusively in the U.S.
I think there is definitely diffusion and diversification to be considered from an AI implementation perspective. Last year, South Korea equity market almost doubled, and it's because, well, number one, valuation, but number two, also because of the concentration of the AI play in its equity market. You look at Chinese equity market last year with the DeepSeek news, that has certainly also helped kind of support sentiment towards the market. So AI is definitely a global theme, concentrated in the US, but as we think about kind of not just the build out, but also the application layer, this is where international market looks a little bit more interesting compared to before. Even in Europe, I'm based in London, I speak to investors and clients all across Europe and globally as well. In Europe, people complain about, okay, it doesn't have a lot of exposure to AI, is it going to be left behind? But actually sectors, traditional sectors like financial services and healthcare, they are ripe for disruption, and investors are looking forward to kind of thinking about what AI can do to those particularly thought of as traditional sectors in Europe. So globally, there are sectors that can really benefit from application of AI. We're seeing productivity boost coming through on a sector basis, and I think that would drive the next phase of earnings growth.
And you think even in a market like the Kospi, like South Korea, where we've seen all that upside, that there could potentially be more upside from this trend?
Well, if you look at the relative performance of emerging market over developed market, you look at that ratio, yes, it's rallied last year. It rebounded and outperformed developed markets last year, but we're starting from a multi-year, almost a decade of underperformance, right? So here, it's also closely tied to the dollar. If the dollar stays at the current level, maybe even weaken a little bit, that gives the incentive for capitals to perhaps go outside of the US to seek international opportunities. But here I would say really be selective rather than across the board, because at times of transformation driven by AI, it's not a rising tide lifting all boat. It's creating winners, but it's also creating losers. So really thinking about being very selective, which layer of AI do we want to have exposure to?
I also wanted to ask how rates fit into this picture. I mean, that goes back to the balance sheet. It speaks to the willingness to spend of some of these guys. Do you think we're getting 3 cuts here in the US this year, or what's your outlook now that we know Kevin Warsh is going to be in charge of the Fed?
Well, markets are looking at 2, and it's not starting until second half of the year. We think that sounds about right. I would say that, like people look at Kevin Walsh and say, is he dovish? Is he hawkish? We actually think that framing is misplaced, is missing the bigger picture, which is actually how is he going to manage pressure to cut rate in the context of the broader economy and in the context of the broader environment. Here, the good news is that actually labor market is softer than the actual economy. This week we're not going to have the NFP because of the partial shutdown of the government, but the big picture is that we have been in this no firing, no hiring stasis in the US labor market for a while, and one of the Fed's mandate is maximum employment. So if the labor market is somewhat soft compared to before, it gives them the macro cover to cut rate without it being like a huge political debate. And here the combination of actually the economy seemingly stronger than the labor market. You look at yesterday's ISM data, which is stronger than almost all the economists' forecasts. The combination of a strong economy and a slightly softer labor market, and what this means for the Fed, given its maximum employment mandate, together with inflation, of course, actually paints a picture of risk-on environment for assets, because the stronger growth supports earnings, and the rate environment, it's going to be manageable, even though term premium should go higher, and equities are in a good position in this environment.
A changing of the guard at Disney. The company's officially announced that Bob Iger's successor is Josh D'Amaro, the chairman of Disney Experiences. He's going to take over the House of Mouse next month. Joining us for more is Geetha Ranganathan, a Bloomberg Intelligence U.S. media analyst. Geetha, it's not a surprise here, right? We've sort of had this drip that this was coming in recent days. But what do you think of D'Amaro as the choice? And I think, there's some questions about whether it's going to stick this time, because this is the second attempt at putting the head of parks in charge of the company.
Yeah, absolutely, Julie. Thanks so much for having me. Yes, this has been a long time coming, but I think this time things are a little different. I think Wall Street now realizes the importance of the parks business. I think it was a little bit underappreciated last time around, and we've really kind of seen the whole composition of the Walt Disney Company change. I mean, this is a great portfolio of assets. It used to be mainly a cable network company with a great film studio division. And there were some theme parks, but that has completely changed. I mean, just a few years ago, theme parks were about 35% of profits. Now they are about 60% of profits. So there's, it's very, very clear that, parks are going to be the main profit engine for this company going forward. And I think having Josh D'Amaro kind of take charge here really kind of underscores the importance of that division and just tells us how important the strategy for parks is going to be going forward. I think this time is different also because, they finally, I think, got a handle on the streaming business, which was what the problem was when Bob Chapek took over the reins last time. And I think, though they do have a good strategy in place, and having Dana Walden now as the chief creative officer should kind of keep that engine running too pretty well, Julie.
I was surprised a little bit by the timing of this, Geetha, that it's effective March 18th when the company has its annual meeting, because there had been talk that Iger would finish out the year. Were you surprised by that? And what is that? Is that sort of a signal that Iger's ready to step out of the way?
I think he finally is ready to step out of the way. I mean, he seems to even signal that he wants to do that so that the new CEO has breathing space, can kind of figure out his own path forward and his own strategy. Because last time, remember, he was criticized for kind of lingering on as Bob Chapek tried to find his way. And that might have eventually kind of, ruffled some feathers, caused some friction. We really don't know what happened. But I think this time he really kind of wants this clean cut, Julie.
As you mentioned, the other sort of main contender for this job, Dana Walden, gets a new title today too, President and Chief Creative Officer. And she really is viewed as someone who has deep ties to Hollywood's creative community. Is this title enough to get her to stay at Disney?
I think it is. I think she also realizes the importance of the parks business. I think naming her as CEO, yes, it would have been great for, the creative part of the business. I mean, Disney at its core is really all about telling stories, and she knows how to do that very well. But when it comes to experience at the parks, obviously she doesn't have any. So I think she understands that too. Having her, I mean, this is a historic role. Disney has never really had a chief creative officer before. So I think it definitely elevates her kind of, I think should definitely keep her in that position, and she should probably stay on, hopefully.
And then I guess my other question is, what does Damaro need to do to help the stock break out of the doldrums? It's what, like 4 years now going on where we've seen mostly sideways movement from Disney.
Yeah, I think this up and down with the domestic parks. So we've kind of seen, attendance really kind of go up and down quite a bit. It's bounced around. We saw that huge surge post-pandemic, but then the past few quarters, we've kind of seen, macroeconomic concerns. We've seen softness from international visitations. We've seen competition from Epic Universe. So there has kind of been this perfect storm a little bit, and then now you have the weather and all of that kind of playing into, lower leisure travel. But I think what is really good in terms of Disney is, yes, it's not a linear path. I mean, you're going to see a lot of lumpiness. You're going to see a lot of volatility quarter by quarter. But then if you kind of just zoom out and look at the picture long term, they have all of the growth drivers in place. So remember, they do have the 60 billion capex investment in the parks business. The cruise capacity is going to double. And Julie, as we just look even to fiscal 2026, I mean, 40% of the growth in parks is going to come from new cruise capacity. And so I think as we kind of see that reflected in the numbers, the valuation, I think, we are going to see a re-rating of multiples. It's just going to take a little bit of time to play out. And of course, the other big wild card is going to be streaming. As soon as they kind of show greater pricing power, more streaming profitability, higher margins, again, that should drive multiple expansion as well.
I mean, I've been enjoying Wonder Man as of late on Disney Plus, but I was already a subscriber, so I'm not making them any new money. The other wild card, it seems to me, is the consumer here, Geeta, because as you well know, it ain't cheap to go to those Disney parks. Disney cruises, I know cruises across the board, not just at Disney, the selling point is the value that they say people get on those vacations, but how vulnerable is Disney to particularly lower end challenged consumers here?
Yeah, I mean, there's always that vulnerability, Julie. I mean, this is a cyclical business. There are going to be some ups and downs. But I think overall, they are very well diversified, even in their parks portfolio. Yes, there's no doubt domestic parks are a huge portion of that parks business. But then, of course, you again have that diversification with the international parks. Remember, there is this huge expansion that is happening internationally. In fact, on March 29th, we have the World of Frozen opening in Disneyland Paris, which basically doubles the capacity of that second Disney park there. So, they're doing a lot of different things. Yes, you are going to have a little bit of bumpiness, but I think overall, as you kind of zoom out and take a step back, they are in pretty good shape as well.